Module 7. Deferred compensation. Deferred compensation is a financial arrangement in which a portion of an employee's income is paid out at a later date than when the income was actually earned. There are two types of deferred compensation plans, qualified and non-qualified. Qualified deferred compensation plans, such as the 401k and 403b, are governed by the Employee Retirement Income Security Act, or ERISA, and offer tax benefits to both employers and employees. Contributions to these plans are usually made with pre-tax dollars, reducing the employee's taxable income in the year of the contribution. The funds grow tax-deferred, meaning that taxes on investment gains are not paid until the money is withdrawn, typically after retirement when the employee may be in a lower tax bracket. Non-qualified deferred compensation plans are not subject to ERISA guidelines and are more flexible but offer fewer tax advantages. They are often used by employers as a tool to retain key employees, like executives, as they can be designed to provide benefits to these employees at specific times, such as upon retirement or in the event of a change in company ownership. Contributions to non-qualified plans are made with after-tax dollars, but like qualified plans, the earnings on investments are tax-deferred until withdrawal. Tax implications. For employees, the primary benefit is the deferral of taxes. Employees do not pay income taxes on the deferred money or its investment earnings until they receive the distribution. This can be particularly beneficial if they are in a lower tax bracket at the time of receiving the compensation. Employers can deduct the cost of deferred compensation when the employee recognizes it as income, aligning the deduction with the employee's income recognition. Deferred compensation is subject to income tax when the employee receives the benefits, which could coincide with other sources of income, like Social Security, potentially putting them in a higher tax bracket. Still, for most people, their income tax bracket is lower when they are retired, making deferred compensation advantageous. Moreover, the extra growth that results from the money being held tax-free during the period of the deferral makes it highly advantageous. Deferred compensation plans are heavily regulated, especially qualified plans, which must comply with ERISA and IRS guidelines. Non-qualified plans, while more flexible, still need to comply with specific IRS rules to ensure the deferral of taxation for employees. Let's look at some examples of deferred compensation strategies. Traditional IRA. A traditional IRA, individual retirement account, is a key component of retirement planning in the United States, offering tax advantages that are designed to encourage long-term savings. When you contribute to a traditional IRA, your contributions are often made with pre-tax dollars. This means that you can deduct the amount you contribute from your gross income, effectively reducing your taxable income for the year. As of 2024, the contribution limit is set at $6,500 or $7,500 if you're 50 years or older. However, it's important to note that if you or your spouse are covered by a retirement plan at work, the ability to deduct these contributions depends on your modified adjusted gross income and filing status. There are income thresholds beyond which the deductibility of your contributions gradually decreases and eventually phases out entirely. One of the significant advantages of a traditional IRA is that the earnings in the account, such as interest, dividends, or capital gains, grow tax-deferred. This means that you won't pay taxes on these earnings until you withdraw them, which is typically during retirement. This allows your savings to grow more rapidly than they might in a taxable account. When it comes to withdrawals, the rules are designed to encourage savers to keep their funds in the IRA until retirement. Withdrawals from your traditional IRA are taxed as ordinary income in the year you take the distribution. Although you can start taking penalty-free withdrawals at age 59 and a half, you are required to start taking minimum distributions beginning at age 72. These required minimum distributions are based on your life expectancy and account balance. If you withdraw funds before age 59 and a half, you will generally face a 10% early withdrawal penalty, although there are exceptions for specific situations like first-time home purchases and certain medical expenses. A traditional IRA is a powerful tool for retirement savings, offering tax-deferred growth and potential tax deductions on contributions. However, it's governed by a set of rules designed to encourage long-term saving and investment, with specific stipulations regarding contributions, withdrawals, and distributions. Roth IRA. A Roth IRA differs with the traditional IRA primarily in terms of tax treatment and withdrawal rules. In a Roth IRA, contributions are made with after-tax dollars. This means you pay taxes on your income before contributing to the IRA. The standout benefit of a Roth IRA is the tax-free withdrawal feature. When you retire, both your contributions and the earnings they have generated can be withdrawn without incurring any additional taxes, provided certain conditions are met. This aspect is particularly attractive to those who expect to be in a higher tax bracket during their retirement years, as it offers the advantage of tax-free income later in life. Another notable feature of the Roth IRA is the absence of required minimum distributions. Unlike traditional IRAs, where you are required to start taking minimum distributions at age 72, Roth IRAs have no such mandate. This allows your investments to continue to grow tax-free for as long as you choose, providing a significant advantage for long-term wealth accumulation and estate planning. It also offers more flexibility in retirement planning, as you're not compelled to withdraw funds at a certain age. When comparing Roth IRAs to traditional IRAs, the primary difference lies in the timing of the tax advantage. With traditional IRAs, the tax benefit comes up front in the form of tax-deductible contributions. However, when you withdraw funds in retirement, those distributions are taxed as ordinary income. This could mean facing higher taxes if you are in a higher tax bracket during retirement. On the other hand, Roth IRAs provide their tax benefit at the back end. While you don't get a tax deduction on your contributions, the trade-off is the ability to withdraw funds tax-free during retirement. Eligibility to contribute to a Roth IRA is subject to income limits. High earners may be restricted or completely phased out from contributing to a Roth IRA, although there are strategies, like the backdoor Roth IRA, that offer a workaround to these income limits. SEP and Simple IRAs. SEP, Simplified Employee Pension, IRAs, and Simple, Savings Incentive Match Plan for Employees, IRAs, are retirement savings plans that cater to the needs of small business owners and their employees, offering an alternative to the more commonly known traditional IRAs. While all these plans encourage saving for retirement with certain tax advantages, they differ significantly in their structure, contribution limits, and suitability for different types of employers and employees. SEP IRAs are designed primarily for self-employed people or small business owners with few or no employees. One of the key features of a SEP IRA is its higher contribution limit compared to traditional IRAs. For instance, a business owner can contribute up to 25% of their income or a maximum of $61,000 as of 2023, which is significantly higher than the traditional IRA limit. This makes SEP IRAs an attractive option for those who wish to save a larger portion of their income for retirement. Contributions to SEP IRAs are made by the employer only and are tax-deductible as a business expense. This plan is straightforward to administer, making it a popular choice for small businesses that want a low-cost, low-maintenance retirement solution. Simple IRAs are aimed at slightly larger small businesses, typically those with up to 100 employees. They allow both employees and employers to contribute, with the employer either matching employee contributions up to 3% of their salary or contributing a fixed 2% regardless of the employee's contribution. For 2023, the contribution limit for employees is $14,000, which is higher than that of a traditional IRA but lower than that of a SEP IRA. Simple IRAs are an excellent middle ground for businesses that are too large for SEP IRAs but not yet ready for the complexities of a 401k. 401k. The 40K plan is a cornerstone of retirement savings in the United States, particularly for employees of medium to larger businesses, and stands distinct from traditional IRAs in several key aspects. Designed as an employer-sponsored plan, the 401k offers unique features that cater to a broad range of employees and employers, making it a versatile and widely adopted retirement savings vehicle. Unlike traditional IRAs, which are primarily individual retirement accounts with relatively lower contribution limits, 401k plans allow for significantly higher contributions. For example, in 2023, an employee can contribute up to $20,500 to their 401k plan, with an additional catch-up contribution of $6,500 for those aged 50 and older. This higher contribution limit makes 401k plans particularly attractive for employees looking to save substantial amounts for retirement. Another distinctive feature of the 401k plan is the potential for employer matching contributions. Many employers offer to match a portion of the employee's contributions, effectively providing additional funding to the employee's retirement savings. This feature is a powerful incentive for employee participation and can significantly enhance the retirement savings accumulated over time. Moreover, 401k plans often provide a range of investment options, allowing employees to tailor their investment strategies according to their risk tolerance and retirement goals. This flexibility is a marked contrast to traditional IRAs, where investment options may be more limited depending on the IRA provider. The 401k also offers both traditional and Roth options. The traditional 401k contributions are made with pre-tax dollars, reducing the employee's taxable income, but withdrawals during retirement are taxed as ordinary income. The Roth 401k works with after-tax contributions, similar to a Roth IRA, offering tax-free withdrawals in retirement. Tax treatment for 401k contributions and withdrawals also differs from traditional IRAs. While traditional IRAs may have deductibility limits based on income and participation in other retirement plans, 401k contributions are generally made pre-tax, lowering taxable income regardless of other retirement plan participation. Additionally, 401k plans are subject to required minimum distributions, similar to traditional IRAs, starting at age 72. However, unlike traditional IRAs, if you are still working and don't own more than 5% of the business you're employed by, you can delay taking these distributions from your current employer's 401k until retirement. Thank you for watching our course on federal income taxation. We hope to see you in other courses, and best of luck.